Hey everyone, it's Ahmet with Down to Trade. It's Monday, November 28th, 2022. We finally did it. We broke above 100% net return for the year. So we're really excited about it. And I wanted to go over how that actually looks and answer a few questions about it. Also, I wanted to talk about how to properly enter an iron condor in this low volatility market. So without further ado, let's get down to trading. Now, before we get into our discussion today, I wanted to examine which type of return I'm referring to. It's important to make the distinction as there are many different metrics used out there when traders make their claims about their return. As you'll see, the return I use is very simplistic but also very accurate. I do my best not to allow my audience to be misled in any way with my performance. So when I discuss my return, whether I'm talking about daily, monthly, quarterly, or even annual returns, I am not talking about return on investment. I say that because it seems many traders post their return on investment or ROI, and it makes it appear that they're doing much better than they actually are. When I show you my return, I'm actually talking about our rate of return. What is the difference, you might ask? Well, let's just take a look. When talking about return on investment versus rate of return, we have to distinguish what they actually mean. Return on investment is simply net income divided by the amount invested, whereas rate of return is simply ending balance minus beginning balance, all divided by beginning balance. Now, I realize this might seem confusing to some of you, so let's use a quick example to kind of showcase the difference. Let's say for this example that you have a beginning account balance of $10,000, and today you purchased 100 shares of ABC Company at $5 per share. Now, sometime later, the stock price increased and you were able to exit that trade at $7 per share for a $200 profit. Great job. Now our ending balance is $10,200. How would these two measures look at this scenario? Well, with the return on investment, we're dividing our $200 profit by the $500 we initially invested in this one trade, which would give us an ROI or return on investment of 40%. And that sounds amazing. I would love to be able to tell people that I made a 40% return today. But this can be misleading. When we look at our rate of return, we see that we divide our $200 profit by our beginning account balance, which of course was $10,000. This would give us a rate of return of 2%. Now, I know that's not quite as exhilarating, but in my opinion, it's the truest quantity of return that I can give someone for this one strategy. Now, I'm not saying that return on investment is not a valid measurement. On the contrary, it is fantastic when comparing a number of investment strategies. But for our purposes, I found that the rate of return is much more sufficient and accurate as a measure of our performance. Let's face it, if I were quoting my return on investment, I probably surpassed 100% return on investment back in the first or second quarter of the year. Now, as you know, the first 2 quarters of the year were actually traded with my personal account, and you can go watch my previous videos on YouTube for a very thorough and detailed recap of the first half of that year, or of this year. Then, in July of this year, I opened the Down to Trade room to the public and opened the new dedicated trading account and this journal, which you can see here. As we can see, we began this new journal with a new account balance at the beginning of July with an initial balance of $30,000. And that was actual money in the account starting at $30,000. Since then, we've made a net profit after commissions and fees of $9,380 for a return or a rate of return of 31%. Now, in the first quarter, we had a net return of 22.4%, followed by a net return of 24.6% in the second quarter. The third quarter yielded a return of 14%, and so far in this fourth quarter, we're at 15.1%. Now, one question I received yesterday was, how can I surpass 100% rate of return when the 4 quarterly returns don't actually add up to 100%? And what that means is someone was asking, well, 22.4 plus 24.6 plus 14 plus 15 doesn't add up to 100%. So how can I be at 100%? And this is simply because returns are actually compounded. So let's take a look at a very quick example to illustrate this. To keep things very simple, we're just going to say we have $100 in our account balance at the beginning of the year. At the end of the first quarter, we made $22.40 in profits. Now, dividing our profit by the beginning balance of $100 gives us a quarterly return of 22.4. In the second quarter, we made $30.11 in profit. We actually have to divide the profit by the beginning balance of second quarter. And doing so would give us a return of 24.6%. We do this again for both the third and fourth quarters, we see that by the end of the year, we have doubled our account balance, even though the quarterly return values don't actually add up to 100%. And this is the magic of compound returns. So we started with 100, we're now at 200. Even though the individual quarterly returns don't actually add up to 100% because of compounding returns, because the returns are compounded, we actually yielded a 100% return for the year. So that's our year so far. We still have a couple days of trading left in November, and we are hoping for a big month in December with the final rate hikes for the year coming up, I believe, on December 14th. Now, looking at the daily tab, we can take a look at our daily totals for the last several months, as well as our monthly returns. Let's get to, obviously, so we started this journal again in July. I've brought this up in so many videos so far. We had a horrible month in July. August was pretty good. We beat our expected return for the month. We expected 6.3. We almost got to 9%. September was okay. We were expecting 6.3 again, and we ended up with about 4.4% return. October was fantastic. We were hoping for 6.7, and we ended with just over 10% return for that month. So far in November, we should be at 5.5%, and we're pretty much at 4.5%. So we're a little bit behind for the month of November, but again, I'm still quite happy with our overall annual return of 100%. And here we have our actual journal entries, which, as you can see, it's been a rough second half of the year, but we've been able to stay profitable despite the choppy news, which has been so troublesome to traders this year. Now, that said, I am aware of the fact that several communities opened earlier this year, teaching their methodologies for trading the 0DTE on the SPX. I'm also aware that several of them are no longer teaching these strategies due to poor performance. And in no way am I celebrating their struggles, even though they are in fact my competition. On the contrary, I do know their pain in an all too familiar way, as I've been there several times. My success is only due to my mathematical approach to analyzing the best parameters for the strategy. When I started, I heard so many people tell me that my approach was worthless because I was entering too far out of the money, or my spreads were too wide, or my stops were too close. I sincerely heard it all. But I trusted the statistical tools which I employ to develop the strategy, and it has worked out for a second year in a row. Sadly, many of those individuals who doubted my rules are unfortunately the same ones who open their own trade rooms, and sadly, a lot of them are the ones that have failed. Not only do I feel for these traders, but I also feel for their clients and subscribers who unfortunately have learned a somewhat less than perfect strategy. And unfortunately, this only works to spread this false idea that trading 0DTE options on the SPX is not possible or is not profitable, which I wholeheartedly disagree with. I believe that any trader can learn to be successful with the right parameters in their tool belt. That said, if you'd like to learn more about our phalanx strategy, or if you'd like to join our small community of traders and trade live with me, go to downtotrade.com. By becoming a member, you'll also be able to download a free copy of this journal so you can track your own performance. You'll also receive a free one-on-one coaching session to discuss whatever aspect of trading or investing that you'd like to. So now I actually want to talk about iron condors and how I trade them differently than my directional vertical spreads. Now, first, let's recap the basics of the failing strategy. Obviously, if we're bullish on the day, we typically look to sell to open a bull put spread with the short leg somewhere in the 7 to 9 delta and the long leg 30 points further out of the money. So it might look something like this. In this example, let's say we sold the 39.45 and we bought to open the 39.15 for a net credit of 75 cents. If we are bearish on the day, we'll typically look to open a bear call spread with the short leg somewhere in the 4 to 6 delta range and the long leg again 30 points further out of the money. So it might look something like this. In this example, we sold the 40.85 call and we bought the 41.15 call. And our net credit was, again, let's just say 75 cents. Well, an iron condor is when you have opposing vertical spreads with the same expiration date. In our strategy, this would happen if we employ both a bull put spread and a bear call spread. Now, why would we actually use this tool? Well, if I believe the market is neither bullish or bearish, but rather will kind of chop sideways all day, I will elect to sell to open the iron condor. I can also leg into an iron condor one spread at a time, meaning if I'm already in, let's say, the bull put spread, I can add the bear call spread later for almost no additional buying power. So the question arises, do we use the same entry parameters for our iron condors? And the simple answer is no. When it comes to iron condors, I will usually try to enter a little further out of the money. And there's a very good mathematical reason for this. Let's just look at the bull put spread of this condor. So just looking at the bull put spread, in other words, let's pretend for a moment that this bear call spread does not exist. So just looking at the bull put spread. Again, for this example, I received 75 cents for the spread. And let's just assume that my probability of profit upon entry or at entry is 90%. This essentially means that if applied volatility remains constant for the remainder of the day, there is statistically a 90% probability that the index will expire above 39.45 at expiration. Now remember, at this point, we are profitable as long as the index closes anywhere above 39.45. So let me do this. So when looking at this, as long as the index closes from here all the way up to infinity, I'm going to be profitable. In the real world, we know that by using our hard stop, we are decreasing our probability of profit by approximately 10%, meaning our effective probability of profit is now approximately 80%. If we started off with 90%, by entering a hard stop, our effective probability of profit is now roughly around 80%. And without a hard stop, our range of profit goes from here all the way to infinity, all the way up forever and ever and ever and ever on this bull put spread. But by entering a hard stop, our range of profit might be from here to infinity. I'm going to try to draw an arrow here. So that might be our effective range, thereby cutting out a portion of our range of profit. This is why our probability of profit will decrease by approximately 10% with the stops that we use. Now, remember, we typically shoot for an 80 to 85 win rate, so this scenario works perfect for us. Starting out at 90% and decreasing by approximately 10% with our hard stop will get us in that roughly 80% win rate area. But let's set aside the hard stop for this discussion and only focus on that 90%, that initial 90%. From the perspective of the bull put spread, our range of profit goes from here to infinity, like we said before. The same can be said of the bear call spread. We're looking at the bear call spread, again, assuming that we have received 75 cents net credit for the spread, and our probability profit for this spread is, again, 90%. Well, from only looking at this bear call spread, our probability of profit or our range of profit goes from 40.85 all the way down to 0. That said, you might think that the overall probability of profit would be 90% because we have 90% up here for our bear call spread, and we have 90% for our probability profit down here on our bull put spread. But unfortunately, that's not how statistics works. The reality is the probability of expiring out of the money for both spreads would actually be closer to 80%. And that 80% is before entering our hard stops. So in other words, instead of starting out at 90%, we're actually with the iron condor, we'd actually be starting out at 80%. And the reason is slightly intuitive if you consider the following. Now that we have both spreads, let's take another look at our range of profit from the perspective of the bull put spread. So we're going to look at this again from the perspective of the bull put spread, but this time we actually do have the bear call spread in place. But looking at the range of profit for this bull put spread, instead of the range of profit going from 39.45 up to infinity, the range of profit now only goes from 39.45 to 40.85. The same can be said of the bear call spread. Instead of the range of profit ranging from 40.85 down to 0, the range of profit is now only from 40.85 down to 39.45. This drastically reduces what values the index can close at expiration for both spreads to be profitable. For this reason, the risk is additive, and we arrive at approximately 80% probability of profit. Now, I will typically go one delta further out when entering an iron condor. Again, so typically when entering a bull put spread, I'm looking for a delta between 7 and 9 for my short leg. I might be looking for an iron condor. I might be looking for a delta between 6 and 8. For the bear call spread, normally I'd be looking for a delta between 4 and 6. But if I'm entering an iron condor, I now might be looking for a delta between 3 and 5 for my short leg. Now, all other parameters will still remain in effect. I still enter a hard stop, but I will usually treat my spreads individually when it comes to taking profit. And here's what I mean. I will usually try to set a take profit at 50% premium capture on each spread, meaning if the index drops and my premium on my bear call spread drops to say, let's say 35 cents, I will take profit on my bear call spread and look for a bounce in the hopes that my bull put spread will also be triggered out for a profit. This is my template, my default template for this type of trade. And of course, I will often alter it depending on the market, volatility, news events, and honestly, my analysis of sentiment. And there's no way to cover every single type of scenario, but I hope this really gives you a good starting point to consider when you're looking to enter an iron condor. Okay, everybody, I hope you got something positive from this video. I'd love to hear your thoughts, so please leave a comment down below. Let me know what you do for an iron condor, what works for you, what doesn't work. And of course, don't forget to like and subscribe and hit that alert button as well. And again, please visit us at downtotrade.com. I would love to see a good batch of new students who are ready to learn the phalanx in December and hit the ground running in 2023. I really can't wait to see you all there. Take care and happy trading.